And welcome back, Katie Stockton.
Thanks so much, Dale. How are you doing?
Great. Great to have you here. You have anything to add to the King Dollar discussion that you were listening to?
Yeah, I mean, it's really just accelerated, hasn't it? Can I
Yeah,
share my screen today?
sure.
All
Please.
right, let's do it. I'll pull it up. I had the S&P 500 pulled up for
Okay.
obvious reasons. We'll have to get to that too. But
Okay. All right.
in terms of the dollar index, I mean, the acceleration to the upside certainly exhibits positive momentum really across time frames. We need
Yeah.
to contextualize it really long term. This is the monthly bar chart of the dollar index. And you
Okay.
can see a big trading range here with room to the upper boundary. That's back here. It's about 103.65 at its upper boundary. But for
Okay.
those of you who do track the Demark indicators, you can see here a couple red arrows in this 9. What that tells us is over the next 4 months, we should basically see it sort of flatten out or just start to consolidate, digest its gains, if you will, meaning
Okay.
that we won't see a breakout from this range anytime soon.
Okay. It's not a sell. It's kind of a momentum signal that upside acceleration will stall out here.
That's right. Yeah. And sometimes you do see pivots with these signals, but I would assume that it's more of a consolidation, like a pause to refresh the up move. And
Yeah.
noting that the other indicators, like this monthly MACD for one, are pointing higher and do support the uptrend.
Okay.
So we assume that will eventually get out of the range, but it looks like it will be delayed by consolidation when you look at these DeMark signals.
Okay. I know you really respect these Demark signals because every time you're on, you bring them up. And how about reliability of these signals, Katie? Are there a lot of, would you say it has better than a 50% hit rate, or for at least
Yeah, I
directionality?
mean, listen, like they really kind of fill a need in that we all have plenty of momentum gauges that can help us.
Yeah,
But where we all tend to struggle, I think, is in terms of a sell discipline and knowing when these trends are exhausting themselves.
right.
And this is where they kind of fit the bill, at least the ones that I use, which are called TD sequential and TD combo. So I think of them as an overbought, oversold measure that actually is coincident of inflection points. And of course, like anything, they don't always, work, or they're not always timely. But I
Right.
find that when you
What
cross-reference
is?
them,
Yeah, right.
yeah, like, you use the other gauges, you use support and resistance to try to reconcile the signals and determine if they're higher or lower conviction. And with that, we tend to have pretty good success in using them. I've not really formally back tested them. It's not the way I approach markets typically, but if you just even visually back test this dollar index chart, if you look at these 9s, here's, some
Right.
inflections, right? Here's a buy.
Right.
When it's below the price bar, you can see some buy signals. Here's a sell signal here. So there's enough value in them, certainly, that I keep going back to them, as you know.
Okay. So, and you know what? It's not always the indicator, it's who's driving the car, right?
Maybe, yeah.
I mean, you could have a left turn signal, and if you're oblivious behind the wheel, you're going to miss a signal or interpret it wrong. So
Yeah,
do you
it's
have,
all, yeah.
go ahead, Katie.
I was just going to say it's all in how you weight the signals, right?
Yeah.
That you're either right or wrong. It's not just one indicator that has all the answers. It's how you combine them.
So are we getting the inverse in S&Ps where momentum should begin to slow around this 4,100 level as 4,150 as we approach very important critical support?
Yeah, the critical support for me is roughly 4,200. We can certainly widen that out a little bit based on the
Yeah.
February lows. We are looking for a retest here. And by retest, we mean just a pullback the pullback to deepen at this point to
Yeah.
these lows in here. And just on Friday, what we saw, this was kind of interesting and disconcerting. This Fibonacci retracement level, which was roughly 4340, was taken out. And when you see the 61.8% retracement taken out, then it tends to give way to a 100% retracement. That's 4157 and change. And that, of course, would take us back below the sort of support level that we've been watching for months now. And this is a really key level. So this 4200 is based on previous highs and lows on the chart, and also another Fibonacci retracement level that's longer term in nature. This is on the weekly bar chart. And you can see also, depending on the time at which it happens, it'll be at risk of breaking this cloud-based support as well. Indicators are looking pretty sad right now.
They are.
Yeah.
Okay. So risk off, dollar higher. I know that you've been in the business long enough that when we get some type of risk off that's really accelerating, that we should get some type of recovery in the bond market. I mean, the bond market, I just saw a tweet that HYG has lost a third of its value this year.
Isn't that wild? Yeah.
Yeah. So
I mean, no doubt these are proper downtrends, and at the same time, there are some indications that we'll at least get a counter trend move to take advantage of, certainly in relative terms. So I'll show you a couple of things. This is on TLT. So this is the Treasury ETF versus the S&P 500 as a ratio. And you can see this just massive underperformance. And it did, really accelerate this year to date. But now we have some signs of downside exhaustion in that ratio to support a relief rally in relative terms, meaning a phase of outperformance by treasuries versus the equity market. It's kind of an easy call in a way to make right now. And then if you look at those trusty Demark indicators, there was a sell signal on TLT back here. That was in April of 2020. And for the first time, based on that model, this week, we should see a buy signal. So it's, just something that kind of makes us perk up a little bit. We're not rushing out to buy treasuries here until we see some improved momentum behind them. We always like to see that confirmation, but it looks like it may be heading that direction.
So the whole world, Katie, was in love with commodities and commodity stocks, super, grand super cycle and everything like that. And, the oil shares and the miners were the stars for quite some time, and they're really getting clipped. Is this going to be a break to buy in the energy sector and the mining sector, this recent pullback? You see anything there?
It's been interesting, especially as of late last week. We saw such broad participation on the downside, and that included all these commodity related stocks and actual commodities.
Freeport got bludgeoned.
Newmont even. The worst performing sector in the S&P 500 on Friday was the materials sector, which nobody really seems to talk about that, but I just thought that was kind of interesting.
Well, they love
them.
People still love. I mean, that's commodities haven't been more fashionable since the 70s. So
down 3.7%.
People are learning the lesson that they correct too. So I don't know about you. I just see this as a breather, not the beginning of a bear market in commodities, but a well-deserved correction anyway.
Yeah, agreed. And here's the uptrend on the monthly chart of crude oil. And what we're seeing, I think, is the necessary relief from what was a pretty prolonged overbought condition. We've actually been more constructive on energy and also materials, especially in relative strength terms. But we suspect that we'll get this pullback here. And, people feel like they probably can't hide anywhere if the S&P 500 is going to break down. I don't think people are going to feel much safety, except perhaps in precious metals, as the inverse correlation is not very strong between gold and the equity market, but gold does, of course, have that kind of safe haven property and might be a place to at least park some money.
Gosh, your cloud support in crude, probably because of the aberration in 2020, it comes in all the way down at like what, $10?
Yeah, this is,
cloud support.
I'd probably ignore it. It's
Yeah,
because it's
it
been more
drops off.
range bound.
Yeah, it drops off a cliff. Looks
It
like
does.
Wile E. Coyote
And I have
in
to
the
show you,
cartoon.
this
Go
is
ahead.
interesting. On the cloud itself, this is something we've been really watching very closely in the cloud. It's pretty interesting.
Bitcoin.
Bitcoin.
Yeah.
I don't know if you were going to ask me about it, but
That,
look at this here. You see
yeah.
this second week below. So if it confirms below about 40,000 this Friday, or well, actually at the end of the week, that would be a pretty big cloud breakdown for Bitcoin. And naturally, Bitcoin's had this positive correlation to metrics like the Nasdaq 100, and it's just being treated like a risk asset here.
It's a stepchild now.
Mm-hmm.
All right. So under cloud support and forecast for rain, do you have any major support levels you'd look at if we get this breakdown on
Yeah,
Bitcoin?
I always gravitate towards, well, certainly previous lows and highs. And that's why I do think some people are going to focus on the
30.
The 30,000 area, just based
Yeah.
on the lows from back in here.
Right.
But what with the Fibonacci's, we think it could be a bit worse than that, especially because these things, the sort of high beta nature of the cryptocurrency space. This 27,200 level is a key Fibonacci retracement level that we're tracking. So we're using that as a gauge of secondary support that would be targeted by a breakdown. And you can see that the relief rally did actually generate an overbought condition on the weekly chart. And that, of course, is not a positive when you see it stall near resistance.
Like that chart, Katie.
Yeah.
I'm trying to think of what we haven't talked about. Anything else on your mind?
I should mention that we just launched an ETF as
Oh
of
yeah,
March.
I heard. Congratulations.
Thank you so much. Yeah, we're really excited about it. And it's really kind of interesting because it's systematic. It's based on our methodology. The ticker is TAC or TACK. And the holdings in TAC right now, they really lean very defensive. So it's not like wholly risk off at this time, but it has the ability to move from sectors, from a top-down perspective, into treasuries, into gold. And it's done that partially. It's about 25% exposed to treasuries, short-term and long-term, and gold. And then the sector exposure leans a bit more defensive too. So with that, you've seen, this is the ratio versus the S&P. You've seen it outperform, of course, in the weaker tape.
Oh, that's really something. Listed where? NYSE?
Yeah, NYSE ARCA.
ARCA. Okay. All right. Well, I think I'll buy some.
Great.
Knowing about your
Please
management.
do.
And I
think it's a great way to get the US large cap equity exposure, but with the asset allocation piece that helps you avoid some of the big drawdowns. That it's a very long-term strategy. And when the market is working, it should leverage that by being in the right sectors, because we all know that that's one of the best ways, I think, to outperform the S&P 500 is having the sector momentum and relative strength on your side.
And betting on the jockey instead of the horse. How about that? So really wish you a lot of success with that, Katie. And
thanks, Dale.
Really appreciate you coming by. You give us, in such a expedient manner, you give us so many good looks and things to consider. I can't think of any asset class that we haven't covered. We've covered crypto, covered S&Ps, commodities. I think we got the job done in record time, and not because I was rushing you or anything, just that you're good at what you do.
Thank you, Dale. I appreciate it.
All right. So we'll be talking later this summer, hopefully, Katie. And
everyone
check out Katie's ETF, TAC, which means, when you're on a sailboat, you have to tack depending upon the wind, right, Katie? I just gave you a deadline.
That's right. Yes, there is that sort of analog to the sailing and the nautical sort of navigating the choppy waters of the market.
Yeah. Well, that's what I'm saying. You bet on the captain. And I've seen Katie's work long enough to know that I'd still wear a life preserver, but I'd get on her boat anytime. So thank you, Katie. Appreciate it.
Take care.
All right. Katie Stockton, everybody. Take it to heart. Fade Katie and her ideas at your own peril. So remember, everyone, don't just count your pips, count your blessings. We'll be back tomorrow, and you could join the team in just about a half an hour for the morning edge. Want to remind everyone, if you're having some good consistent weeks, you know, where you're up 1%, 0.5%, you put a few of those weeks together. Just imagine having more equity to trade. It takes money to make money. I know, because when you're undercapitalized, every trade is life or death, and you're emotional about it. And that's your biggest hindrance to trading. It's not the signal, it's all in our heads. So everyone have a great week. Have a good Monday, and we'll see you all tomorrow. I will. You'll see the team. Thank you very much, Paul. See you, Monica. See you, Sinatra. Adios, everyone. Don't just count your ETFs, count your blessings. See you.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.